Joining us now, Brian Levitt, global market strategist for North America at Invesco. Recently, you've been feeling okay about the stock market and prospects for 2020.
Right.
Does this change anything for you?
No, I don't think that this changes the larger overarching narrative. Now, look, what do we know as investors? We know that geopolitical uncertainty, policy uncertainty brings forward market volatility, which we're seeing. And this could persist. I mean, we'll have to see what the retaliation looks like and what additional happenings look like. But the reality is the big macro stories have not changed. And I'd be very surprised if we look back a year from now or 2 years from now and say this was the event that ended the elongated business and market cycle.
In the past, and we don't want to overstate what's happened so far, but even military conflicts that become much more widespread or that that turn into something much larger aren't necessarily market killers.
That is correct. That is correct. And you could go back to that quote that Warren Buffett had during the 2008 financial crisis, where he said in the 20th century, we endured 2 world wars and any number of other things, and the Dow went from 40 to 11,000.
I can remember when the Iraq war started. I remember different times when the market has actually gone up.
Exactly.
Over the first Iraq war, the second.
So, but what investors need to focus on, again, I'll come back to it's the big macro narrative. The big macro narrative is it's still a slow growth world. Inflation is benign. Policies accommodative. Equities are cheap to bonds. None of that changes. Now, these types of events in a dangerous world happen. We saw it last year with the Saudi oil fields, and yet it was a year that markets were up 30%. I think what most investors would be surprised to know is that when geopolitical uncertainty spikes, and when you get to these near record highs in geopolitical uncertainty, markets are actually positive 12 months forward.
Pompeo is making some more comments here. He says the U.S. remains committed to de-escalation with Iran, but the act against Soleimani was lawful. What I was getting to about the stock market with the way it reacts to conflict was one thing, but I was just going to get to, but then again, the oil markets.
Right.
If the Straits of Hormuz were closed, or if there was a really serious supply disruption, and it was $100 oil globally, then I could see some type of effect on the global economy.
I mean, that's a different story. And, so for a long period of time now, commodity prices have been relatively stable and been supportive for U.S. consumption. And, any type of spike to the U.S. consumer on oil prices could slow economic activity. But remember, we have policy levers to be able to respond to that. So this is an environment where the Federal Reserve has stepped in to support growth each step along the way. And if conditions get too tight in the United States, whether that's from the yield curve flattening, the dollar strengthening, commodity prices, moving in a significant, I think policymakers will step in and
You think
support.
that a situation like this could force the Fed's hand?
Well, I don't think that the Fed is going to move as a result of, what we've seen overnight. And I don't think yet. I think you'd have to watch financial conditions. If you get to a place where we were last summer, where the yield curve had inverted, and we have concerns about commodity prices, concerns about the dollar, then the Federal Reserve would act if they believe we were in a period of price instability, deflationary impulses, then the Fed would respond. But no, I don't think the Fed responds to this immediately.